Today, Fragility rules, the DFA daily to the 10th of December 2021. Hello again, it's Martin North from Digital Finance Analytics, world latest posts covering finance and property news with a distinctively Australian flavour. Well, US stocks limped lower on Thursday, and the Dow raised meager gains in the final minutes of trade, ahead of an important read of consumer inflation that could deliver a fresh jolt to financial markets tomorrow. Investors have moved from jitters over the impact of the Omicron variant of the coronavirus that causes COVID-19 to concerns about supercharged inflation, which could influence the Federal Reserve's plan to tighten monetary policy. The Consumer Price Index will be released at 8:30 a.m. Eastern Time on Friday in the US. So the S&P 500 slipped on Thursday following a three-day rally as investors weighed up positive labour market data ahead of Friday's inflation report that certainly could intensify expectations for a faster pace of Federal Reserve monetary policy tightening. The S&P 500 fell 0.71%, the Dow Jones Industrial Average was flat, and the Nasdaq fell 1.7%. The broader market is taking a breather after the run-up over the last 4 days going into tomorrow's Consumer Price Index report, David Wagner, portfolio manager at Aptus Capital Advisors, said in an interview. Economists forecast that the CPI index for November could have risen by 6.8%, up from 6.2%, led by a sharp increase in rising rents. That would make it the fastest pace of inflation since 1990. We're looking at a lot of the different real estate trusts and a lot of different apartment companies and seeing rental growth for these types of companies of about 10%, he added. Rising rental rates will lead to a CPI reading that's going to be higher than expected, and more importantly, it's going to be longer than expected. Federal Reserve Chairman Jerome Powell signalled last month that the Fed will consider stepping up the pace of bond purchasing tapering to curb inflation pressures. And US interest rates are set to begin to rise in September, the first of 5 increases that Morgan Stanley is forecasting over the next 2 years. In the note, Morgan Stanley's economics team said it brought forward its forecast for the start of the rate hike cycle by 2 months, primarily because of increasingly hawkish signals from Federal Reserve policymakers. Morgan Stanley's rate outlook bolsters its view that the US dollar will continue to rally against its peers in the coming months, the strategist said. Although the contours of our outlook for inflation and labour markets has not changed, aspects of the Fed's reaction function may have. Fed Chairman Jerome Powell's recent remarks suggest the Fed is now placing a higher priority on price stability in order to support sustained strength in labour markets, they said. The yield on the US 10-year note was lower by 0.78% to 1.497%. And on the jobs front, data continued to show an improving labour market as jobless claims fell to 184,000. That's the lowest in more than 52 years. Energy was the biggest drag on the broader market as oil prices fell 2% on concerns that fresh restrictions in Europe could weigh on the travel and energy demand, albeit not as much as initially feared. Oil demand is unlikely to escape completely unscathed, though the effects from the restrictions will probably not be nearly as seriously as initial feared, said Commerzbank in a note. Apple gave up some gains, though Wall Street continues to talk up further growth ahead for the tech giant amid expectations for strong iPhone demand and new product launches. We believe the risk-reward is very favourable at current levels for this safety blanket tech stalwart, Wedbush said. Demand for Apple's iPhone 13 is outpacing supply by about 10 million units globally. Healthcare, meanwhile, added to gains from a day earlier as CVS Health soared to a record high after the drugstore chain said sales were set to strengthen, underpinned by expansion of healthcare services. In other news, GameStop fell more than 10% after the video game retailer reported third-quarter losses that were wider than expected and failed to provide an update on strategies to bolster growth. And over in China, consumer inflation there rose less than expected, while producer prices rose more. Owing to a jump in vegetable prices up 30.6%, November CPI rose 2.3% from a year ago. The median forecast was around 2.5%. It was the fastest pace since August 2020. The decline in pork prices, down 32.7%, was slowing. Excluding pork, the CPI would have risen by 3%. Service prices remained soft. Excluding food and energy, the core CPI was at 1.2% over the past year compared with 1.3% previously. Producer price inflation slowed from 13.5% in October to 12.9% in November, and economists had forecast a 12.1% pace. Recall officials moved to boost supplies, including coal, helping to ease the strong upside pressures. And officials moved to a more pro-growth stance, which means that inflation will not stand in the way of further easing monetary policy via reserve requirements, even if not interest rates, next year. Meanwhile, Evergrande and the Kaiser Group formally missed debt servicing payments on dollar obligations. Still, unlike the end of the property bubble in the US and Europe, China has been forcing banks to continue to lend. This keeps the proverbial treadmill going. The lending figures for November showed new yuan loans, which track bank lending, rose by 50% to 1.27 trillion from 826 billion in October. Aggregate financing, which adds shadow banking activity to bank lending, rose to 2.61 trillion from 1.59 trillion previously. And the PBOC announced a 2 percentage point hike in the reserve requirements for foreign currency deposits. Now, that's going to probably weigh on the yuan initially. Meanwhile, China Evergrande has officially been labelled a defaulter for the first time, the latest milestone in a months-long financial drama that's likely to culminate in a massive restructuring of the world's most indebted developer. Fitch Ratings cut Evergrande to restricted default over its failure to make 2 coupon payments by the end of a grace period on Monday, a move that may trigger cross-defaults on the developer's $19.2 billion of dollar debt. The downgrade came just minutes after Fitch applied the same default label to Kaiser Group, which failed to repay a $400 million bond that matured on Tuesday. Together, the two companies account for about 15% of outstanding dollar bonds sold by Chinese developers. So you can see there's a lot going on. Expect more shaky times and more volatility ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.